So the next one, we will study about the factors affecting the capital structure. So the first one factor affecting capital structure is cash flows positions. Means we a company has to fix either to raise from debt or to raise from the equity. Now, if a company raises funds from the debt, it has to make a fixed cash payment obligations, and it should have sufficient cash with the company itself. Why? For normal business operations, that company has to pay interest, but company has to incur lots of normal expenses, as well as company has to invest in fixed assets, or for meeting any other debt commitment charges. That means payment of dividend and some payment, any other fixed payment is to be made. So if a company is having sufficient cash with itself, then company can go for debt. So company has to take care of this information also. The next one is interest coverage ratio. Interest coverage ratio means how much interest will be, how many times the interest will be paid in relation to profits. That interest coverage ratio can be calculated in number of times with the relationship between earning before interest and tax of a company and fixed interest obligations. If this ratio is higher, the lower shall be the risk of company failing to meet the interest payment obligations. Means अगर ये ratio higher होगी तो कंपनी अपनी इंटरेस्ट पेमेंट्स को इजीली मीट कर सकती है. If this ratio is not sufficient, then it will not be able to make interest payments regularly. The next is debt service coverage ratio. Debt service coverage ratio, it takes care the deficiencies which are due to interest coverage ratio, because company has to arrange for depreciation also. Company has to arrange for those expenses which are being written off. So company's debt service ratio, as again, that how to calculate the debt service coverage ratio. Debt service coverage ratio can be calculated by having profit after tax plus depreciation plus interest plus non-cash expenses divided by preference dividend and interest and repayment obligations. A higher debt service coverage ratio will definitely help the company to meet its cash commitments. So higher, if a company, any company which is having higher debt service coverage ratio can go for debt. The next one is return on investment. Return on investment means that relationship between uh, capital and a profit. If a firm is earning sufficient amount of return on investment, then the company can definitely go for debt capital, and company can use the trading on equity. Trading on equity, if I recall you, that is the more use of debt would lead to increase in earning per share. The cost of debt. The next factor is cost of debt. If a company is able, if a business is able to borrow at a lower rate, it will increase the capacity to employ higher debt. Thus, more debt can be used if a company wishes to raise the funds through a lower rate. The next one is tax rate. Since interest is a tax deductible expense, means interest is deducted from the profits before paying the tax. That's why the income on which the tax is to be paid, it is being reduced. So if you recall, or if you reanalyze your last example, there you will know that you will get that the company is borrowing at a 10% and the tax rate is 30%. So after tax, the cost of debt is only 7%. That company is paying 30% tax and 70% is in the pocket of company, for which company has to just pay only 10% interest. That means the cost of debt is 7%. If a higher tax rate will be there, that debt, it will make debt relatively cheaper and its attraction towards the equity. The next one is cost of equity. Stock owners, they expect a rate of return from the equity which is parallel with the risk, because equity shares capital is equity shareholders, they are having risk, because when a company will be increasing its debt capacity, the financial risk will be increased. And in the cases of emergency, if a company is not able to pay its debt, how the company will be uh, able to pay its equity, that is to the shareholder. कंपनी अगर डिबेंचर्स का पैसा नहीं पे कर पा रही है तो शेयर्स होल्डर को कैसे पे करेगी? So cost of equity is also one of the factor of raising funds through debt or equity, means it is a factor which is helping in capital structure. Flotation cost. Different sources, they involve a different flotation cost. Getting a loan from the financial institution may not cost too much. So these are the consideration. This is also the one of the consideration to be taken care. Risk consideration. There are two types of risk. One is business risk and other one is financial risk. Financial risk, again and again we are saying that financial risk is payment of interest. When the company is not able to pay the debts in time, interest, preference dividend. So this is the financial risk. And business risk, it depends upon the operating cost. If a business is able to operate its business affairs efficiently, definitely the operating cost is lower. So the total risk depend upon the business risk and financial risk. If business risk is lower, it will raise the capacity to use higher debt. If the business risk is higher, then it will lower down the capacity to raise funds through the debts. The other one is flexibility. If a firm uses its debt potential to the full, it loses the flexibility to issue further debt. To maintain flexibility, the company must maintain some borrowing power to take care of unforeseen circumstances. So, controlling factor, debt normally does not cause a dilution of control. A public issue may reduce the management holdings, means अगर कंपनी अगर इक्विटी के थ्रू फंड्स रेज करती है तो कंपनी की कंट्रोलिंग power, that is being gone into the different hands. If company wishes that control should be with limited persons, so company will again choose for the debt. Sometimes some regulatory frameworks are there. SEBI guidelines under the company has to work under the SEBI guidelines. For meeting these norms, these procedures, company has to think over the choice of source of finance. These are the few factors which help in uh, fixing the capital structure of a company. These are the factors similar to financing decisions. Most of the factors these are common to financing decisions. So it's all for the day. Thank you.